When you hand someone a new video game or, I don't know, sit them down in front of a complex piece of software, right?
Yeah. Mhm.
The absolute first thing almost everyone wants to do is just hit skip on the tutorial. Like you just want to jump right into the action, start pressing buttons, and see what happens.
Oh, absolutely. I mean, human nature is fundamentally wired to seek out those immediate rewards. We are biologically primed to just, toss the instruction manual and go straight for the experience.
Right, but let me paint a picture for you. Imagine that game is actually a multi-million-dollar flight simulator.
Okay, high stakes.
Yeah, exactly. And instead of a simple game over screen that you can just easily reset, hitting the wrong sequence of buttons means you just accidentally nosedived the Boeing 747 right into the ground.
Yeah, that changes the math a bit.
It really does. Suddenly, spending a few weeks in that boring tutorial doesn't seem like such a bad idea. So today, for you, the listener who wants to crack the code of the financial markets, we're looking at a stack of research that reveals what is essentially the ultimate cheat code for survival.
The simulator.
Exactly. We're talking about demo trading. Our mission today on this deep dive is to master the simulator. Because the reality revealed in our source documents is that understanding this virtual environment is, well, it's really the only actual path to surviving the live markets.
It's the definitive foundational step. And what's just endlessly fascinating to me is how universally misunderstood this step actually is by the general public.
Oh, completely. So
Yes.
we've got a comprehensive step-by-step guide in front of us today. We're going to break down exactly what this virtual sandbox is,
Right.
the hidden psychological traps that almost all beginners unknowingly fall into.
There are a lot of them.
Yeah, definitely. Plus, a highly specific mathematical training camp outlined in the research. And finally, a completely counterintuitive secret to making the jump to real money.
That last part always catches people off guard.
It really does. So whether you're looking to trade full-time or you're just, managing your own retirement portfolio, you need to understand the mechanics first. So let's unpack how to do that without losing a dime.
Sounds good. Let's get into it.
To anchor us, what exactly are we looking at when we open one of these simulator accounts? I mean, what's under the hood?
So at its core, a demo account allows you to practice trading using real market prices, but with entirely virtual money. And that first part is critical.
The real prices part.
Exactly. The prices flashing on your screen are real. They reflect actual real-time market movements. It's the exact same live data feed that professional traders, in Wall Street or the City of London are analyzing right at that second.
Wow, so you're seeing the real matrix, basically.
Yeah, you are. But the capital you're deploying is entirely simulated. So no actual money is at risk. It's a sandbox designed specifically to teach you the mechanics of the software. It is not there to guarantee your future wealth.
Right, and let's pause right there because market mechanics can sound like a bit of corporate jargon, What are we actually doing in this sandbox, and why do so many people approach it the wrong way?
Well, the research highlights this really fascinating behavioral flaw. Beginners almost universally open a virtual account with a single ego-driven goal:
Which is what?
to prove to themselves that they can be profitable.
Ah.
Yeah, they think, I need to prove I can make money here, and once I prove that, then I'll go live.
Wait, so the industry standard approach to demo accounts, like
Uh-huh.
the way almost everyone uses them, is essentially setting beginners up to fail from day one.
It is fundamentally backwards. The source explicitly states that proving you can make fake money tells you absolutely nothing about your ability to make real money.
That is wild. So what is the actual point then?
The actual purpose of this virtual environment is strictly to remove your ignorance of how the market operates physically.
Physically, meaning like the buttons and levers.
Exactly. For example, you need to understand leverage. In simple terms, leverage means you're borrowing money from your broker to control a much larger position than your own cash would allow, right?
Amplifying your buying power.
Yeah, but if you don't understand how to calculate that mathematically, you can completely blow your account balance in a matter of seconds.
Jeez. It's essentially financial dynamite. You need to know exactly how long the fuse is before you light it.
That is a perfect way to look at it. You also need to see how a stop loss physically executes.
And for anyone who might need a refresher, a stop loss is that automated order designed to close your trade if the asset's price drops to a certain level, like capping your losses.
Exactly. But on a screen, you need to watch how the market sometimes jumps over that price, or, how the platform handles the execution in real time. You need to watch price movements to realize that a stock or currency doesn't just travel in a straight line.
Right, it doesn't just go up or down
No,
smoothly.
it breathes. It moves up, pulls back, consolidates, and moves again. You use the simulator to learn how to navigate the platform so confidently that you aren't fumbling for the right button when the stakes are real.
It makes me think of taking your driving test, actually.
Oh, how so?
Well, demo trading is like practicing for your driving test in a completely empty mega mall parking lot on a Sunday morning.
Yeah,
You learn the mechanics. You find out exactly how sensitive the brake pedal is. You figure out the blind spots. You learn how to put the car in reverse without stalling the engine.
right, the basics.
Yeah, but driving in an empty parking lot absolutely does not teach you how your body is going to react when a semi-truck suddenly swerves into your lane on a crowded highway at 70 miles per hour.
That is a brilliant analogy. The biological response is the missing variable there.
Exactly.
Because in that parking lot, your resting heart rate is completely normal.
Mm.
On the highway, your brain is instantly flooded with cortisol and adrenaline. And the research details exactly what the virtual environment cannot teach you for this exact reason.
Because it's too safe.
Right, it creates an emotional void. It cannot simulate how the heavy pressure feels when your real rent money is on the line. It doesn't teach you how taking a real financial loss is going to impact your decision-making on the very next trade.
Oh, like the revenge trading spiral.
Exactly. It completely fails to teach you how human greed and fear will influence your live execution. Those lessons only arrive when the money is real, but, and this is the crucial sequence, you cannot survive those emotional highway lessons if you haven't first achieved mechanical competence in the parking lot.
Wow, yeah. So, if the virtual environment completely lacks that real money adrenaline, it creates a sort of psychological vacuum. And, nature abhors a vacuum. Our deep dive into the text reveals that this lack of pressure breeds some incredibly dangerous habits, doesn't it?
It really does. The most prevalent trap the text identifies is what they call the fantasy account.
The fantasy account. Okay, break that down for us.
This happens when a trader decides to practice with a virtual 50,000 pound account, even though their actual real world starting capital is only going to be, say, 300 pounds.
Oh, wow.
Yeah, doing this creates dangerously false expectations.
Why is that a problem, though? I mean, isn't the point just to get screen time and practice reading the charts? Like, why does the fake starting balance matter so much if you're just clicking buttons?
Because it completely distorts your perception of risk, loss, and survival. Let's do the math on a drawdown. If you are trading a 50,000 pound virtual account and you lose 500 pounds on a poorly executed trade, that is merely a 1% loss. Your brain barely registers it. You just shrug it off and take another trade.
Right. It's pennies relative to the total.
Exactly. But if you transition to your real 300 pound account, that exact same 500 pound loss means you are entirely bankrupt and you actually owe the broker money.
Wow. You're building a pain tolerance for tiny paper cuts, but in the live market, you're going to be dealing with amputations. You aren't learning how your real journey is actually going to feel.
And because you don't feel any pain from those virtual paper cuts, it leads directly to a secondary danger. The research describes it as reckless abandon.
Reckless abandon. So just throwing caution to the wind.
Essentially, yes. Since the money isn't real and there are no consequences, traders start throwing massive position sizes at the wall just to see what sticks. They take 10 random trades a day without any risk management, simply to chase the dopamine hit of seeing a winning screen.
They treat the financial markets like a casino where the chips are free.
Exactly. But they are actively hardwiring terrible psychological habits into their brain. Habits that will immediately destroy their real account later.
So what's the fix?
The rule to combat this is rigid. You must treat the virtual money as if it is real and size the account to perfectly match your intended reality.
Okay, so if the fantasy account is dangerous and reckless trading is a one-way ticket to bad habits, what is the alternative? Does a trader just stay in this safe, properly sized simulator forever until their strategy is absolutely flawless? Like, what is the actual harm in just staying in the sandbox?
The harm is that a mathematically flawless strategy in a vacuum just doesn't exist in reality. If you stay in the simulation forever, you are artificially shielding yourself from the core component of successful trading, which is emotional discipline.
Interesting. So you can't learn discipline without skin in the game.
The text is adamant here. Real discipline only develops under real conditions. If you never face the pressure of a real financial loss, you never learn how to control your panic. If you never experience the thrill of a real monetary game, you never learn how to control your greed.
Right.
Perpetual simulation makes you a theoretical expert, but a practical novice. You have to face the fire eventually.
And I imagine the opposite extreme is just as bad.
Yeah.
Where you're like rushing through it.
Yeah.
Someone opens the simulator, plays exactly 3 trades, decides the lack of adrenaline is boring, and immediately wires their life savings to a broker.
Precisely. They skip the tutorial and nosedive the 747.
Man, what a mess. So if we can't stay in the simulator forever and we can't just skip it and rush to the live markets, there has to be a structural sweet spot, a mathematical framework to get us from point A to point B without picking up bad habits.
Yes, and the source transitions right here from behavioral theory into a highly actionable, rigid blueprint. It starts with what is essentially a mechanical familiarity phase.
Okay, phase 1. What are we doing?
It's a strict limit of your first 5 to 10 trades.
Wait, only 5 to 10? That seems surprisingly low. I mean, if I'm trying to master a complex institutional-grade platform, why wouldn't I spend 100 trades just clicking around to see what everything does?
Because the goal of this initial phase is purely navigational. You aren't trying to build a profitable strategy yet. You are simply building muscle memory. Think about typing on a new computer keyboard with a slightly different layout.
Yeah, you hit the wrong keys at first.
Exactly. At first, you have to look down at your hands, you make typos. But in financial markets, a typo costs you capital. So you use these first 5 to 10 trades simply to learn how to place different order types. You practice setting your stop losses and profit targets so that when you need to act fast, you aren't second-guessing which button to click.
It just gets the clumsiness out of your system,
Right.
right? Finding the brakes in the empty parking lot.
Right.
So once you know where the accelerator is, you graduate to the actual practice.
The core of the virtual phase, yes. The text mandates a structured practice period of 30 to 50 trades.
Let's dissect that number. Why exactly 30 to 50? If I am a fast learner, why can't I just do 15 structured trades and call it a day?
It comes down to statistical variance and habit formation. 15 trades simply isn't enough data to prove anything. You could just be experiencing a lucky streak in a highly favorable market condition.
Ah, so 50 gives you a real picture.
50 trades provides a robust sample size. It forces you to navigate through different market moods, times when the price is trending beautifully and times when it is completely erratic. But the most crucial metric here isn't the number of trades.
What is it?
It is the risk parameters. The research insists you must risk a consistent, tiny amount of virtual money per trade, specifically 3 to 5 pounds.
Wait, let me make sure I'm following the logic there. If I am practicing on a 500-pound demo account, why am I restricting my risk to just 3 to 5 pounds? That is incredibly small. It's barely 1% of the account.
This is where we see a profound shift in mindset. The author provides a quote that anchors this entire philosophy. Whether you're up or down is irrelevant at this stage. Whether you followed your rules is everything.
Wow.
The focus is 100% on process, not profit. By keeping the virtual risk tiny, you remove the distraction of the monetary outcome and focus entirely on whether your execution was flawless.
So you aren't trying to make virtual millions. You're trying to prove that you can follow a strict set of instructions without deviating. You are building the habit of a meticulous auditor before you even touch real money.
Exactly. And to enforce that auditor mindset, every single trade must be journaled.
Oh, so writing it all down.
The specific setup, the execution, the outcome, the notes, it all has to be recorded in detail. After you complete those 30 to 50 structured trades, you stop. You don't take one more trade.
Hard stop at 50.
Yes. You enter an evaluation phase where you review that journal to look for patterns. You honestly assess your consistency. You dig in to understand the mechanical why behind your winning trades and your losing trades.
It's a comprehensive self-audit. But, reviewing a journal is kind of subjective. How do you actually know if you passed the audit? Like, when you're sitting there looking at your 50 recorded trades, what is the specific metric that tells you it is time to cross the threshold and put real money on the line?
The research provides a strict binary checklist. It is a series of questions, and if you answer no to any single one of them, you are not ready.
Okay, let's hear them.
First, can you calculate your position size on the fly?
What does that actually look like in practice?
It means if you are looking at a chart and you determine you need a 20 pip stop loss, a pip being a micro measurement of price movement, meaning you're willing to let the asset's price move against you by 20 micro measurements before you exit the trade, do you know exactly what lot size you need to input so that those 20 pips equal exactly 5 pounds of risk?
Man, so the math has to be completely second nature. You can't be scrambling for a calculator while the market is moving and the price is fluctuating.
Precisely. Next on the checklist, can you hold through a 15 to 20 pip pullback without panicking?
Meaning what exactly?
Meaning, when your screen is flashing red and the trade goes against you temporarily, do you have the emotional regulation to let your strategy play out, or do you manually close the trade out of fear?
Ah, that is the emotional regulation piece starting to peek through the mechanics.
It is. The checklist also asks if you have realistic expectations. Have you abandoned the fantasy that you are going to double your account balance every single month?
Which we know is impossible.
Right. And finally, the ultimate reality check. Do you actually have 100 to 400 pounds of real disposable money available? Capital that is absolutely not required for your rent, your groceries, or your utility bills.
Purely disposable risk capital.
Yeah.
Okay, so let's assume I check all those boxes. I did my 50 trades, my math is flawless, I survived the pullbacks without sweating, and I have 300 pounds of disposable income ready to go.
You've graduated.
I've graduated. Now, we hit what I think is the most jarring revelation in this entire deep dive.
The actual transition to the live market.
Yes, because most people, myself included, would assume that if I was trading a 500-pound demo account, I should deposit 500 pounds of real money and just keep doing exactly what I was doing. But the text says that is entirely wrong. When you move to a live account, you must actually start smaller than your simulator account.
The instructions are incredibly counterintuitive, I know, but the text lays out a specific mathematical scenario. Let's say you properly traded that 500-pound virtual account, right?
Okay.
You were using a position size of 0.01 to 0.02 lots, and you were risking 3 to 5 pounds per trade. When you transition to live trading, your account should start at just 200 to 300 pounds.
A huge drop.
Yes. You should drop your position size down to a strict 0.01 lots, and you should only be risking 1 to 2 pounds per trade.
You are deliberately cutting your capital and your risk in half.
Yeah.
Let's think about the mechanics of this. It's like deep-sea diving, isn't it?
Oh, how so?
It's decompression sickness. You don't just shoot straight from the bottom of the ocean floor to the surface in one continuous motion. The sudden, violent change in atmospheric pressure will literally kill you.
Right.
You have to stop at different depths for extended periods to let your biology acclimatize to the new environment. Dropping your lot size and your risk parameters is essentially financial decompression.
That is a phenomenal way to conceptualize it. You drop the risk because real money introduces a sudden, massive change in psychological pressure that the virtual environment simply cannot replicate. Even if it is just 1 or 2 pounds on the line, the sheer fact that it is your real hard-earned money triggers a physiological response.
Yeah, your brain knows the difference.
Exactly. Your heart rate elevates, your palms might sweat, your brain begins to release cortisol.
The semi-truck is officially swerving into your lane.
And starting smaller than your simulation allows for gradual emotional acclimatization. You are giving your nervous system time to adapt to the reality of financial risk without that risk being so large that it paralyzes your decision-making abilities.
That makes perfect sense. So how long do you stay at that tiny risk level?
The source dictates that you maintain this tiny reduced risk for your first 20 to 30 live trades. Only after you have maintained strict discipline through those real money executions do you gradually increase your risk to match your original simulation levels.
Wow. So when we pull all these threads together, the mechanics, the psychological traps, the mathematical training camp, the decompression transition, what is the ultimate takeaway for someone looking to navigate this space?
The author leaves us with a synthesis that reframes the entire concept. Many beginners view demo trading as fake trading. They see it as an annoying, mandatory roadblock keeping them from the excitement of the real market.
Right, something to rush through.
Exactly. But the text states categorically that this is a destructive mindset. Demo trading is not fake trading. It is deliberate practice.
It is the foundation of professional execution.
It is the Olympic athlete running repetitive fundamental drills on an empty track before stepping into the stadium for the championship. It is the concert violinist playing the exact same scales thousands of times in a quiet room before performing for a sold-out auditorium. And perhaps most acutely, it is the surgeon practicing complex procedures on a digital simulation for months before ever holding a scalpel over a living, breathing patient. It is the only reliable mechanism we have to remove the profound mechanical ignorance that consistently destroys live accounts.
It strips away your ego and forces you to respect the absolute unforgiving nature of the arena you're entering. Well, that wraps up our exploration into the simulator. For you listening, whether you are managing your own portfolio or looking to trade more actively, the message is incredibly clear. Respect the tutorial. Thank you for joining us today as we unpack the hidden mechanics, the psychological traps, and the true purpose of virtual trading. But before we sign off, I want to leave you with one final provocative thought inspired by everything we've just discussed.
I always appreciate a lingering question.
We've established that the virtual phase allows you to trade entirely free from the biological pressures of human greed, fear, and cortisol. You are executing purely based on mathematical rules. So does that experience actually give you a brief temporary glimpse into how a purely logical, automated machine views and trades the financial markets?
Oh, that's fascinating.
Right. And if that is true, how can you train your own human brain to hold on to that cold, calculating machine mindset once the real money and the real human panic finally kicks in?
That, I believe, is the ultimate challenge of the transition.
It really is. Because at the end of the day, skipping the tutorial might get you into the game faster. But when you are flying a 747 in the real world, you better know exactly what every single button does before you leave the runway. Keep learning, keep practicing, and we will catch you on the next deep dive.